for coming by and checking out the Market Chameleon pre-market show with the main man, the King Chameleon, Dimitri Pogomonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker-dealer. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
All right.
And let me share my screen. And for today, Will, I got some good questions from Rob actually about implied volatility. How does implied volatility translate to daily stock moves or the predicted daily stock moves? How does it translate to the expected earnings move? And I think these are good questions. And I'm going to try to do today, Will, is simplify implied volatility, what the model, because implied volatility really comes from option prices where you put it back into a model and you come out with this number. And when we talk about the Black-Scholes model, binomial model, whatever, option pricing model, there are different variations. I'm going to try to simplify so you guys could kind of maybe see what the objective of the model is, because the model, what it's trying to do is take the options and translate it to trading volatility. It's using options to trade stock volatility. And I'm going to try to kind of show you examples in the very simplified, as simplified version as I could get. Okay. And then we'll talk about, well, how does implied volatility translate to daily moves and why do we even do it? All right. So that's what I'm going to try to cover today. And if there are questions along the way, Will, let me know. I'll try to answer those questions. But before we get to that, let's take a quick look at the pre-market report, see what's going on today, and then I'm going to show you an example, what implied volatility versus realized volatility might look like if you visualize it. All right.
Perfect.
So, pre-market report, and right now we're looking at stocks that are trading in pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. And I'm coming down here, I see 47 stocks made our percentage gainers list, 123 on the percentage decliners. So from this perspective, we're looking like a more bearish bias at the open. I'm going to filter this list down to S&P 500 stocks. We want to take out closed-end funds, ETFs, preferred stocks, leverage products, all those. Let's get rid of them to see what's going on in the S&P 500. And to do that, I'm going to use this filter here in ETF, drop it down. I'm going to go to the SPY ETF, which is the S&P 500 ETF. And by choosing that, the list below gets filtered by the holdings in SPY, which are the S&P 500 constituents. And here I see 12 stocks made our percentage gainers list, 25 on the decliners. So again, slightly more bearish bias at the open. We had a pretty volatile day yesterday, actually, up really big in the morning, sold down almost to unchanged, rallied back up. So a lot of intraday volatility yesterday. Today, so it looks like slightly negative. And I think on the positive side, I see Netflix up 10% in a pre-market after issuing their earnings. So this little E here's Netflix up 10%. This little E is letting us know it just reported earnings either yesterday after the market closed or today before the market open. And they're, I think they're up actually as much as 13%. And I was going to discuss Netflix earnings and kind of open up their metrics, their key metrics to look at, to get an idea what you guys think, if it's fairly priced, overvalued, undervalued. But I did get a good question on implied volatility. And since we are options focused, I'll take that. We could come back to Netflix. If people want to look at that, come back to it later this week. Okay. And I'm going to use SPY as an example when we go to implied volatility. And the question was, if we look at the IB, implied vol, in SPY, how do we get to here, the average daily move? Well, what's the predictive move, a one-day move? All right. So over here, you see yesterday, if we use the option implied volatility, the day before, the options were implying a daily move of 1.6%. The stock was up 1.2%. So it closed within that range. And when we look at it, when we look at implied volatility, let's just narrow down kind of what the option pricing model and what that strategy looks like. What are we attempting to narrow our risk down, and what are we betting on, right? Because when you're trading the Black-Scholes model the way it's intended, with your hedging your gamma risk, your delta risk, what are you actually betting on, right? What is because obviously at that point you're not betting on on a directional move that the stock's going to move one way or the other. And really what you're doing is narrowing down your bet, your risk, to the volatility of the stock between now and the expiration of that option. So maybe if we look at it visually, here's SPY, and here's SPY daily changes. So yesterday it was up 1.2%. Day before it was up 2.6. Day before that it was down 2.3. So these are daily moves. Okay, and these are simple returns, daily simple returns. And you can see that from day to day, they're not the same. It could move very little, like 0.3%, or it could move, 2.6%. And when we look at it go up or down, and it could range, right, from low to, and sometimes we could see that there's a high of 3.1%. But if we see it, we can, by just looking at it, I'm looking at it right here, and we don't see it moving 50%. We don't see it moving 10% from day to day, not even 5%, but it can from day to day move, between almost unchanged. Like if I'm just looking in the past, I don't know, what is this, like almost a month here, let's say down to here, I see a high move of like 3%, a lot of 2%. And if I was going to make a bet, with Rob or you, Will, and this would be the bet. You guys ever see the over under with, like basketball, they'll say both teams score over or on, by the end of the game, will both teams score more or less than 215 points combined, right? So you could say, I think combined they're going to score more than 215, or they're going to score below 215. Okay, so it's an over under, and think of it as buyers of options will think of implied volatility. If you're a buyer of implied volatility, you believe that the daily moves will be over a certain amount. If you're a seller of it, you think they're going to be below a certain amount. And here, if we take an option that expires in a month, right? Well, we have all these days, so it's not just one day, and that's what implied volatility is. It's average implied moves, right? So average. So if we started, let's say our bet was on average, right? I think that the daily moves will be below 1.5%, and Will thinks it's above 1.5%. Okay. Well, on this day, it only moved up 0.8. So theoretically, well, on this day, I thought it was going to be below, thought it was going to be above. So it is below, and I get the difference, right, between 1.5 and 0.8%. So 0.7%. Okay. On this day, again, it was below 1.5. So on that day, I get that difference, 0.4%. So the stock, instead of moving $5, it only moved 4.4, 4.5. So I get 50 cents, right? But on this day, it moved more than 1.5%. So now I owe, right? And that's what it's doing every day, right? Is it moving below or above the average daily implied move, right? So the seller would be losing on days that it went above that implied, the buyer would be making. And at the end, you would sum it all up, and then based on whoever was right or wrong, that would be. So that's kind of like what the Black-Scholes model is attempting to do. Now, these are simple returns. Black-Scholes model uses log returns, which make more sense because simple returns aren't additive. Just to simplify, imagine this, if the stock's in a Black-Scholes model, if the stock starts at 100, if it's up 1%, and then the next day it's down 1%, it's back to 100. Okay, simple returns don't do that, right? Because on a simple return, up 1% from 100 is not the same thing as down 1% from 101. Log returns it is. So you put these in the log returns and saying, okay, from now to expiration, these are the average daily moves. These were the average implied moves. If you took the difference, you're either made or lost based on what happened, right? And of course, to do that, the Black-Scholes model is saying that once you own the options, you're going to trade the stock delta neutral, and if you're trading delta neutral, trading your gamma, managing your vega, all that, then approximately that's how it would equal out. And to get what is the average daily implied move from the option pricing model, well, we take the implied volatility of the option. So we take the stock price times the implied volatility, divide the implied volatility by 100. If you see it this way, it would be, instead of 27, it will be 0.27, 27%. And then you multiply it by, remember, implied volatility is annualized. So you'd have to multiply it by the square root of time, the fraction of time left in the year till expiration. Okay. But if you did it daily, if you just wanted to do it for one day, it would be times the square root of 1 divided by 365, or 365 days in a year, or 252 days if you're using trading days. So 1 divided by 252 days. And this kind of gets you back to, well, what is the implied daily move, right? Because here we see, over here, I'm just eyeballing, right? Let's just say I'm eyeballing and I'm not taking the average. Let's pretend these were log returns. And I would say, well, sometimes it's below 1.5%, sometimes it's above 1.5%, but I think on average, it's up or down 1.5%, right? So I'm just eyeballing it here. And that's what I think on an average day, it's about, if I average them out, it's 1.5%. That's where I think that's where the break even is. So if somebody offered me a very cheap implied volatility and said, well, would you buy a 0.5% move, average average day, I would say, yeah, because over here it looks to me like, that it moves above a 0.5% a lot of times, sometimes by over here by 3% and doesn't move below that many times. But if somebody said average daily move of 5%, well, that's way too high because I don't even see it. So I'd have to have a reason why do you think it's going to be that high? Okay, so when we look at implied volatility versus realized, that's really what we're trying to figure out. Well, what are the options implying today for the next 20 days, 30 days, 60 days? And then if we think about it, well, based on that implied volatility, that means on average, that obviously every day you're going to get a different one, right? But on average, it moves 1.5%. Do I think that's too low or too high? Okay. And if the realized volatility is higher and you're trading the theoretical model, you bought the options and you're trading the theoretical model and the realized volatility ends up being higher than the implied, then you would be making the difference by scalping the stock versus your options. All right, any questions so far? So that's the average daily move on it. And it's not a perfect model, okay? It's a theoretical model. It's not a perfect model. It's just the best model we have that you could kind of apply across the board, all right? So if I had to use a model right now to just input, lots of stocks in, then that's the best available model that we have. Where it doesn't work is on gaps. And the reason is that the Black-Scholes model assumes that stock returns are log normal. They're not going to move very fast from one point to the next point without you being able to hedge it. So Black-Scholes model does not make sense for a stock to go from, like, say 377, or 371. Let's start here. If it starts at 371.13, the Black-Scholes model does not make sense that it could go to 380 without trading at 371.14, 371.15, 371.16 first. Okay, so all the prices from your starting point to your next point, it has to hit first before it gets there. That's the Black-Scholes model. Why? Why does it think that? Because according to the Black-Scholes model, right? And we know it can do that, right? And on earnings, for example, Netflix reports earnings, we know that the probability of it moving, beyond the next point is high, right? It's not going to trade in pennies every penny before it goes up. Like, it went up 10%. So the probability that it first trades at every penny between that is very low. But why does the Black-Scholes model think that it has to trade at every penny before it gets to the next point? Is because theoretically, if you start at 371.13, there's a higher probability that the stock goes to 371.14 than it does to 380, right? Or there's a higher probability if you're starting right now, it goes to 371.15 before it goes to $380. That's the bell-shaped curve, right? That there's a higher probability of each point closer than it is further away. So let's take a look at Netflix. You see Netflix yesterday closed at 240.86, and now it's trading at 266.39. And I'm sure if we looked at the pre-market or after hours trade, we'll see that it did not trade at every penny between 240.86 and 266, because there was an event, because it released earnings. It did not trade at every penny in between before it got there, because it just gapped up, right? Like the the stock market closed, they reported earnings, and then afterwards, it had like before the opening, it had another auction, and it opened up at a different price after the auction. So it wasn't even continuous trading, probably. Or I'm not sure how this one worked, but it moved very fast is the point. And that's where the Black-Scholes model kind of breaks, because and that's why I tell you guys, don't look at the implied volatilities when you're trading earnings, because that model assumes this is not going to even happen, right? It would be broken. You're trading a metric that assumes that what's about to happen is impossible to happen. Okay. And that's why when we trade earnings, you always see us not looking at the implied volatility, but the earnings. What is the implied earnings move, right? What are the options implying the gap, not the implied volatility, not the volatility of the stock, but the actual gap. Where are we going to move from this point to this next point? So let's take a look here. So here you could see this is not a daily move, right, that we were looking at. The implied earnings move was 12.3%. That's what we were looking at. In other words, we're not expecting the stock to move 12.3% on average every day from now to expiration. That's not what we're expecting, right? But we are expecting a big move because there's an earnings, and that's what we have to do, is convert the options and say, well, we got to derive a different value. It's not coming from an implied volatility value. We have to take the options, look at those straddles, and figure out what is the gap implied move in either direction, right? So here, that's what you're seeing. That earnings, let me maybe compare it here. Let me see if we update these. Okay. So you could see here that if you use the Black-Scholes model as you're coming into earnings, and if we convert it to average daily moves, it's like 7.5%. But we're not expecting it to move 7.5% every single day, back and forth, on average. It doesn't work that way. After today, it's probably going to go back to its, whatever average daily moves it's been doing. Actually, it has been doing some big moves here. But that earnings move, that's coming from the straddle, and it's saying that if we look at the straddle, what are the options implying the stock to move post earnings? All right, so that would be the difference. Hopefully it makes sense. Let me know, Will, if you have any questions regarding that. You're on mute, Will.
Sorry about that. I had a sneezing fit. Everyone, no questions, but everyone's super thankful with the explanation, D. I love the way Swami put it. It's like a man behind the machine explaining how it works. It's really a great explanation. Thanks for that.
Oh, thank you. Well, then I'll end it there. We have a couple minutes. I'm not going to get to Netflix today. What was I looking at? I guess I don't have enough time to move on to another subject, so I'll leave it there.
Well, that's perfect. We only got a couple minutes before the opening. We will try to look at Netflix tomorrow. Is that a deal?
Yeah. Let's take a look at Netflix tomorrow. Everybody stay safe out there.
Yeah.
Have a great trading day. Hope to see you guys tomorrow.
Trade and Peace, Chameleon. I did, just so everyone knows, Thomas Petterfy from Interactive Broker was speaking on CNBC today. See if you can grab that off the internet. It was worth a watch.
Oh,
I forgot to mention that.
Yeah.
All right, cool. Have a great day, everyone. Bye, D.